This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Now we want to get to two key interviews. They have to do with earnings. Both shares are higher. Let's get to the first one. We're talking about Chipotle Mexican Grill soaring to a record high. Right now it's up about 9%, so pretty much at its best levels of the session. Fourth quarter sales and profit beat expectations as both transactions and check sizes rose, really defying some of the fears of waning consumer sentiment. Same-store sales growth, folks, you know it. This is so key. A gauge that tracks restaurants that are open for more than a year. That was 8.4%, surpassing the analyst expectations of 7.1%. Revenue, $2.52 billion. Tim, that also topped the $2.49 billion average estimate.
Well, with more on the business, we welcome back Brian Niccol, Chairman and CEO of Chipotle. He joins us on Zoom from Newport Beach, California. Brian, good to see you again. Good to have you with us. Investors are happy with this year, or they're happy with the quarter. Analyst community is too. My question for you is, who do you think you're taking share from right now?
Look, I think what we believe is happening is our operation is executing better than we ever have. And frankly, we've just been on a journey to get back to executing this business to Chipotle standards. So, we feel great about our staffing. We feel great about our culinary. We feel great about our speed. And I think that's why we're being rewarded with customers coming in, and you saw the comp that we delivered that was driven by transaction growth, right? That 8% plus comp was driven by 7.4% transaction growth. And, I think that's a testament to what our teams are doing in our restaurants on all those areas that I just mentioned.
Brian, great to be talking with you again. Dig a little bit deeper for us. First of all, that same-store sales growth really blowing away analyst expectations. Is that sustainable, you think, in the current quarter and maybe throughout the year to see that kind of growth?
What we've guided is mid-single digits for the year in 2024. And, the way we take this approach is we want to make sure we've got a strong value proposition, which based on all our data, we continue to get feedback that the value proposition is really strong. And then we want to make sure that when customers come in, they get the experience that they want. And so what we've seen over the fourth quarter and as we walked into the first quarter is people are telling us they like what they see. Our teams are in position, our food is ready to go, the culinary is dialed in, it tastes delicious, and we're working really hard on the speed aspect so that people don't have to stand in line too long, so they can get down the line, get to the business of enjoying their burrito or bowl. I think we stay focused on that. We'll continue to deliver really good results.
I'm curious, others in the space, something like a McDonald's, they've talked about low-income consumers pulling back on their spending. You guys, your consumer base, what do you expect in terms of U.S. consumer behavior this year? What can you tell us about how the consumer is doing and how they are spending? Because you do talk about transactions up, check sizes rising, but what more can you give us in terms of how the consumer is?
Yeah, so we look at this very closely as well. And first we start with what are people's perceptions of our brand? And the perceptions are really strong right now. People are getting the idea that we're all about fresh food. We're all about food with integrity. They're getting the idea that, hey, this is a great value when I think about what I pay for what I get, the customization, the speed, okay? And so when we look at this among different income cohorts, so less than 40,000, between 40,000, 100,000, over 100,000, we're making progress in every income cohort. So we've seen sales gains with every income group. One thing that I think is happening is, especially the lower income consumer, they are saying, hey, we're going to be really choosy with the money that we choose to spend. You got to give us what we want on our terms. And one of the things that's really great is Chipotle is able to do that, right? We can get you the exact food experience that you want, hopefully at a speed that delights you. And then when you walk away, you feel like, that was money well spent, and I'm going to come do it again.
But let me go back to comp sales in terms of your outlook that you guys put. Brian, why do you think you see growth, though, continuing, but at a slightly slower pace, excuse me?
Look, the way we think about this is we want to continue to focus on executing the basics. Obviously, January, we had to deal with some bad weather across the country. The good news is the days where we haven't seen bad weather, the businesses strengthen right back up. And so we're optimistic about where we can get to. We've switched back to what our pre-pandemic practice was just guiding for the full year. Hopefully what happens is we're able to beat those expectations. That's always our goal. And we'll see how it all unfolds over the course of the year. But we're set up very well to open a lot of restaurants, deliver, I think, really strong in-store experiences and digital experiences, which hopefully will build on the momentum that we've achieved thus far.
Hey, Brian, let's talk more when it comes to labor. 15% of your restaurants are in California. You're joining us from Newport Beach right now. We saw California minimum wage raised this year to $16 per hour. It's going to continue to rise this year and over the next few years. How else, apart from raising prices, is Chipotle going to cope with California's new minimum wage law?
Yeah, look, I mean, we're always working hard on what can we do to be more efficient so that we don't have to pull the pricing lever. You've heard us talk about things like Avocado, where we're automating how we cut, core, and scoop avocados. We're working on some things, automating our digital make line. We're also exploring things on how we could potentially cut our onions, peppers in the restaurants in a more efficient fashion. So we're going to invest in those things. The unfortunate fact is the wage increase is moving much faster than these efficiencies that we're going to be able to find. So price will be part of the puzzle in order to handle the inflation that's looming. But we're going to do everything we can to avoid having to pull that pricing lever. And you'll continue to see us innovate on what we're calling cobotics, so that hopefully we can make the job more efficient, more effective. Team members like it, and it gives the great culinary output that our customers have come to expect.
Totally get it. Other costs, other input costs, corn, avocados, the cost of ingredients. What are we seeing on that front? Are you seeing prices actually going down or increases not as significant as they were before? What can you tell us there? Yeah,
that's right. We're not seeing any deflation, but we've definitely seen a slowdown in the inflation. It's more in the low to mid single digits. There's a couple pockets where we're still watching things like on beef. We're always careful with where the avocado market might be moving. But for the most part, that's, I would say, started to normalize with the exception of a few pockets of inflation that we're still dealing with.
Brian, do you see yourself raising prices this year?
We always try to wait till we get to about the end of the year to assess what we think we need to do. Obviously this California minimum wage movement, we'll have to assess how that it really impacts the business, and we'll take action accordingly. But for the bulk of the business, we usually wait till around the end of the year, see where all the inflation lands, see where our growth lands, see where our productivity lands. And then if we need to, we take pricing usually in that 1 to 2 to 3% range.
Hey, one thing I'm thinking about also, and we saw it play out with some others about the impact of the Middle East conflict. You guys last year talked about entering Kuwait and the UAE this year. Has the conflict in the Middle East, Brian, impacted that timeline at all?
Not yet. Our partner over there is the Al Shaya Group, and they're a terrific operator. They have a lot of brands and a lot of experience of operating over there. So as of right now, we're still on schedule to open this year. Obviously, they will be the first ones to tell us that if we need to change that timeline. The good news is we think they're a great partner. We think they're a great operator. And I think the folks are going to love Chipotle when we're able to finally open our restaurant in that part of the world.
Hey, just got about a minute or so left. Speaking of timelines, I've got 2 quick questions for you. You have been at the company for almost, I think you're coming up on your 6-year anniversary. How are you thinking about that timeline? I mean, investors are happy. Stock is up almost 1,000% in that time. So how are you thinking about kind of the next leg of that timeline for you? Because I've got to imagine there are people knocking at your door saying, can you come do what you did for Chipotle for us? And I'm also curious if there's any timeline for stock split, because it's an expensive stock. Got about a minute.
Yeah, sure. Look, well, what I hope is the next 6 years are like what these last 6 years were from a total performance standpoint. I could do without some of the macro shocks. But it's been a tremendous honor leading this brand. We've got wonderful people. We've got a terrific purpose and product that we provide. And I couldn't be happier to be leading this company. And I'm really excited about all the growth that's in front of us. We're going to go from 3,500 restaurants to 7,000 restaurants. We're going after 4 million average unit volumes. So there's just tremendous growth in front of us, which I'm super excited about.
Yeah.
Everybody asks us about the stock split. we'll have to wait and see what.
Citi raised it. It's now like a street high over 3,000.
Like, how high would it have to get for you to do a split?
Yeah.
Very briefly.
Is there a level? Real quickly.
You know what? We never have a defined level, but it's something we talk about, and if it makes sense to do, we'll do.
All right. Listen, you are always so generous with your time. We really appreciate it. Be well, and thank you so much. Brian Niccol, of course. He's the chairman and chief executive officer of Chipotle Mexican Grill. This stock on a tear, as we said, hitting a record.
27.25 right now, up 9.5% today.
All right, we really appreciate it. We're going to check in with another CEO. We've got the CEO of CVS Health, Karen Lynch. She's coming our way in just a moment. You're listening and watching Bloomberg Businessweek. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Now to another stock on the move, and it's related again to earnings. Shares of CVS Health are up nearly 5% at their high today. Right now, a gain of about 2.4%. CVS Health reported better fourth quarter results than Wall Street expected, and it really did relieve some investor concerns about the impact of rising care expenses, particularly in the company's Aetna insurance unit.
Well, let's get to the outlook, because the drugstore chain now expects annual adjusted earnings of at least $8.30 a share, down from at least $8.50 a share. Cash flow from operations will be at least $12 billion, Carol, down from an earlier outlook of at least $12.5 billion.
All right, delighted to have with us Karen Lynch. She's president and CEO of CVS Health, joining us on Zoom from the company's CVS headquarters in Woonsocket, Rhode Island. Hey, Karen, so nice to have you here with us. Let's start big, broad, if we may. Your business made of three large revenue drivers. First of all, how would you describe the last quarter, and where, were the areas that made managing it a little bit more difficult? Which were upbeat or upside surprises, if you will?
Yeah, hi, Carol. It's a pleasure to be here, and thanks for having me. Mm-hmm. In the fourth quarter, we had strong results in our pharmacy benefit management company. We had very strong results in our pharmacy and consumer wellness segment, which essentially is our stores. And, we continue to demonstrate growth in our Aetna health and business. Where we had challenges in the quarter is really at the end of the year, we saw elevated trends in our Medicare Advantage business, where we saw, trends in outpatient services, think hips and knees. We also saw an increase in utilization in dental and vision. But overall, as you said, we ended the year strong. We delivered on our financial commitments. We grew revenues of 11.5%, and, we delivered EPS of 8.874, which was a really strong result.
Yeah, investors, kudos, because they have set your stock higher today. The results really do suggest that your insurance unit, you were able to manage those costs and drive the quarterly results. Can you continue to do so? Talk to us about kind of the stress and strain from doing that.
Obviously, we have programs in place, whether it's the benefit designs that we put in place, whether it's our, care coordination programs that we have in place, how we contract with our network and our physicians. So, we feel very confident that we can continue to navigate this environment as we move into 2024. We haven't seen anything unusual in the early part of 2024, but things are, still emerging, and we'll monitor it throughout the year.
What was unusual about last quarter? You said hips and knees really dragged on the quarter at the end of the year. What was unusual about that, and why can't you really model for that moving forward?
Yeah, well, what we saw was just an elevated utilization, and I think part of it is, there's been some pent-up demand over a period of time. What we've also seen is more capacity in the healthcare system. So, more outpatient clinics are staffed now, so they can have more, they have more scheduling available to them. So there's a number of factors that, that we wouldn't have seen that, started that elevated trend in the latter half of December, actually.
Hey, Karen, some other health insurers, Humana, United Health, for instance, who obviously are in this field as well, they have warned that these rising costs will mean raising prices to increase profit margins. Will you have to do the same?
Well, I think it all depends on the business that we're in. So for Medicare, CMS essentially sets the rates. And so we received our first rate notice this past week. And so what we've said is, it was in line with expectations, relatively flat, but it didn't cover the overall rising medical trends. So we have the opportunity to go back to CMS and, give them comments, which we'll be doing in the upcoming weeks. So that price is really set, and then we design the benefits around the price that's set by CMS. So we'll be, modifying the benefits as we go, as we learn more about the final rate notice that comes out in April. And then in our commercial business, we obviously have the ability to adjust prices to rising trends, and we've been doing that all along through 23 and into 24.
So this takes into account, because I know you guys had warned, I think it was at the JP Morgan Healthcare conference, that your medical benefit ratio could be higher than expected in the fourth quarter. So I'm just wondering, so you're feeling like that you'll be able to manage that in the rest of the year, or this year specifically?
Yeah. So Carol, in the fourth quarter, we saw some of this emerging trend with medical benefit ratio. So as you saw, we expected, our original guidance was 86%. At the end of the year, which we just reported today, was 86.2%. So it was a little bit higher, but we had anticipated it and talked about it at JP Morgan. As we turn the corner into 2024, we're watching these trends, and we have lots of tools and techniques that we use to help people get the care they need when they need it at the right levels, at the appropriate sites of care, and we help people navigate and coordinate their care.
Hey, Karen, I want to talk about a different part of the business, the second biggest part of the business. That's the pharmacy and consumer wellness segment. Talk to us a little bit about how the retail environment is right now, what you're seeing out there from the consumer. Is the consumer healthy? You have a great view on the American consumer, so share with us those thoughts.
Yeah, so, well, first of all, stepping back, those stores are really another avenue for healthcare delivery. So when consumers are coming into CVS, more likely than not, they're coming in to fill a prescription. So we have seen an increase in, our script volume over the course of 23 and starting in 2024. We built an immunization franchise, so people are coming to our stores for their RSV vaccine, for their COVID vaccines, for their flu vaccines, for their shingle vaccines. That's really creating, additional revenue streams for us and additional value to the consumer, because it offers a convenient place for people to get their immunizations. It's usually right around the corner from your home. We've built digital assets so that you have the ability to schedule online, and so we've made it very convenient for those individuals. And what we're seeing in the front of the store, we're obviously seeing consumer behavior. People are making choices for lower prices. We're seeing more of the CVS brand, where so people are just cost comparison, and we are starting to see people kind of leveraging the CVS brand products. Okay,
so going to generics a little bit, it sounds like. Hey, let's talk about shrinkage. It's a huge problem over the last couple of years.
We all want products to be taken out of jail because it's so frustrating.
They call it retail jail.
It's crazy.
Is it getting any better, or is it still a huge issue?
Goodness.
Is there any improvement?
Yeah, I would say it's a concern for ours, and first and foremost, we're very concerned about the safety of our colleagues, and we put a number of measures in place to make sure that our colleagues are safe. And as you pointed out, we lock things up so that we can deter some of the thieves from coming into our stores and stealing our product. And we've seen it somewhat moderate, but we're working very closely with attorney generals, with local law enforcement, to really have people prosecuted when they are stealing from our stores. And this is not just a CVS health problem. This is a retail problem. And, we all are coordinated to really work with law enforcement so that, we can deter the theft. It is very costly to us. And my big concern is making sure that our colleagues are safe in our stores.
Totally get it. And I'm just curious, it sounds like you've answered it, but I want to ask you about pharmacists specifically walking out. How are you addressing those concerns? And also just concerned about not having enough staff, those pharmacists that have, talked about overlap or not having enough overlap or just talking about burnout. How do you address that specifically? Because that's going to be a big issue.
Yeah, what I'd say is, there's a lot of media coverage on pharmacy walkouts. We actually didn't really have pharmacy walkouts. We didn't close any stores. We were able to staff all the stores. But what we have been doing is making sure that, we and the pharmacists, have one common goal, and that's to make sure that we are caring for our patients and that they're getting the prescriptions that they need. We have been investing, a fair amount of wage investment for our pharmacies. We have also improved our technology, so we're making it more efficient and the operations more efficient, so the pharmacists can actually do what they do best, and that's caring for the patients. We've been investing in recruiting and upskilling and skill development, and we've actually seen a reduction in overall attrition for our pharmacists. So I think we've been making really good progress over the course of the latter half of last year.
Karen, I feel like I'd be remiss if I didn't ask. You talked about script volume being up earlier. Is some of that because of the new weight loss, the new class of weight loss drugs? I mean, what impact are you seeing? Kind of the activity? Are people paying for itself? Is it mostly be covered by insurers? And just unfortunately got about 40 seconds. Forgive me.
Yeah, the weight loss drugs, we have seen a lot of volume in the weight loss drugs. We know that they are effective for diabetes and for weight management. There is a shortage, and we're managing through those shortages. But they are, we are seeing, some of the volume coming from the weight loss drugs across our entire business.
Karen, a great snapshot of so much that is important to the economy. So thank you so much for carving some time out for us. Really, really appreciate it. Karen Lynch, President and Chief Executive Officer of CVS Health, joining us from company headquarters in Rhode Island. The stock's still up about 2.3%.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, history can teach us a lot. 40 years ago, another incumbent president was wrestling with lousy poll ratings, a recent recession, and serious doubts about his age and electoral viability.
Yeah, this story featured in the new issue of Bloomberg Businessweek Magazine. It's available on newsstands. It's on the Bloomberg already and at Bloomberg.com/Businessweek.
Bloomberg Businessweek national correspondent Josh Green wrote it. He's the author of The Rebels, Elizabeth Warren, Bernie Sanders, AOC, and the Rise of the New Left. He's also the author of the #1 New York Times bestseller, Devil's Bargain. Josh joins us on Zoom. Josh, good to see you, have you on the program this afternoon. So it's hard to imagine it being morning for America for President Biden just a few months out from the November election. Why draw the parallels here now?
Well, because, more and more when you look at the direction of the economy and the timing of what's happening in the economy during this election cycle, the more it resembles Ronald Reagan's run for re-election back in 1984. I should hasten to say that this column is not a prediction. It's really just kind of looking at the similarities, and they really, really are striking. Over the last couple of weeks, we've all seen the economic numbers turn around. Jerome Powell came out last week, said the economy is in very good shape. It looks like Biden is going to be running for re-election with an accommodative Fed, that most people expect to cut interest rates. Meanwhile, as we've been reporting, stock market is hitting a record high. If you go back to 1983, oddly enough, Reagan was in the similar situation to Joe Biden. The economy was then just coming off a deep, deep recession with a lot of inflation. Reagan was very unpopular, but in 1983, in the beginning of 1984, the economy started turning around. The Fed started cutting interest rates. All the economic numbers, consumer sentiment started pointing upward. And eventually, Reagan rocketed to a landslide re-election. A big hope among the Biden people is that this economic turnaround that we see in the numbers is eventually, pretty soon, going to have a positive effect for Biden that will lead him, much as it did Reagan in '84, when Reagan was an unpopular, aging president who everybody thought for a brief moment was going to be a one-termer. Biden is hoping that he'll be able to run that same playbook again in November.
And yet, as you so rightly put in your story, Josh, enter political polarization like we've never seen before, it feels like, in this country. And then also just this idea, it's a different era in terms of how people kind of connect their political feelings with how they feel about the economy.
Yeah, that's totally right. That's as you said, that's a big and yet. If you look at, I think the neatest chart in the story, if you look at consumer sentiment in '83, '84, and what happened to it, and you look at it now with our economy and Biden, it's almost identical. But there is one big difference, and that is that back in 1984, the American electorate wasn't as fiercely polarized as it is today. Reagan ended up winning 33% of Democratic voters in 1984. And there isn't any chance that Biden is going to win 33% of Republicans. And partly that's because people's political views have become what political scientists call calcified. Republicans continue to think that the economy is bad shape because there's a Democratic president, the same way that Democrats did when Trump was the Republican president. We're beginning to see Democratic sentiment turn around strongly, and that's helped Joe Biden recover a little bit in the polls. And if you really squint at the latest Gallup numbers, you can see a little bit of an upward trend from independent voters and Republican voters. But in speaking to pollsters and political scientists, it's going to take a lot in order for Biden to get the kind of wind in his sails going into the election that Reagan had in 1984. But it's not impossible, and it's probably the best hope that Biden has going for him.
So for this story, you spoke to Mark Zandi over at Moody's Analytics, who they have a really interesting poll that came out recently that you include in the piece. What does it say about President Biden's electoral prospects? Because we've done a lot of polling too here at Bloomberg, especially in swing states, and Trump is ahead of Biden in many of the issues.
Yeah, so Zandi and Moody's did, and it's actually an entire election model that they do every year. And what it showed, it looks at a lot of historical markers. And basically what it said is that, putting aside all the political factors, the economy looks to be in such a strong shape that their model predicts that Biden will win in November narrowly, based largely on the strength of the economy. And I think it's a good reminder that for all that the political press corps focuses on polls and who's up this week and who's down and whatever the scandal du jour is in Congress, economic fundamentals still matter a lot to people's electoral choices. And the fact is that if you look at history, the economy and the direction of the economy really does matter a lot when an incumbent president is running for re-election. So that's the best thing Biden has going for him. I called up Zandi. I said, do you really think that Biden is going to win? And, he cautioned to say, look, this is by no means a guaranteed prediction. This is just our model. Model turned out to be wrong in 2020. But what it does show is the importance of having an accommodative Fed in an election year, sentiment turning around, inflation turning around, gas prices coming down. That was important for Reagan in 1984. It's important for Biden in 2024. So, right now things are trending in a positive direction for Biden in terms of the economy. What he needs to happen is for the politics to follow that direction.
Well, I'm so glad you left it on that. Now, politics, because what's interesting in your story, Josh, you say at the time many didn't regard Ronald Reagan as the heroic figure in the recovery. They ranked Paul Volcker, head of the Fed, right, much more highly than they did Reagan. Well, here you have, though, a former president, Donald Trump, who's saying he wouldn't reelect Powell, questioning the current Fed chair. So I wonder how that dynamic potentially also might throw a wrench into the outcome here and play against Biden.
It's a great question. I mean, I found a Gallup poll from when Reagan was running for re-election that surveyed corporate leaders, business leaders, and by like a 2-to-1 margin, they said that Volcker was the hero of the turnaround. I think if you polled corporate leaders today, a lot of them would say that Jay Powell is the hero of this turnaround, not Joe Biden. Whether that has a broader effect on, let's say, voters in Michigan, Wisconsin, Pennsylvania, the swing states that are going to decide the election, I don't know. My hunch is that Powell just isn't a well enough a known figure for that to make a difference. But look, on the margins in a close election, everything matters. So maybe there's a block of Jay Powell voters out there that pollsters haven't measured yet, and ought to get out and do so, that could be decisive in the election. We'll see in November.
And Josh, look how quickly the economy, or at least the market, has turned around in recent months. Look how quickly we're starting to see inflation come down in recent months. It's a reminder that there is a long way to go between now and the election. And even though gas prices have come down now, there is a lot of time between now and November.
Yeah, there is time for good and time for bad. I mean, I went back just out of curiosity and looked at inflation-adjusted gas prices now versus November 1984 when Reagan ran. Right now, I think AAA has them at $3.15 a gallon. In November 1984, they were at $3.14 a gallon. So everything's lined up for Joe Biden right now. But look, we could have an oil crisis. We could have, some kind of a geopolitical event in the Middle East that could send those soaring. That would certainly cut against Reagan's chances, both in the Moody's model and probably anybody else's. But on the other hand, if you look directionally, especially given the expectation of multiple Fed cuts, which Goldman Sachs predicts or forecasts 4 between now and the November election,
right?
That really is a tailwind that I think is going to help Joe Biden's chances. The big question is, how entrenched is that partisanship among voters? There is some reason to believe that it still does affect even Republicans and independents.
Really just something to think about. Josh Green, thank you so much. He is Bloomberg Businessweek national correspondent, joining us on Zoom on this Wednesday. You're listening and watching Bloomberg Businessweek, and this is Bloomberg Radio.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Is that you, baby, or just a bird in disguise?
Okay, Carol, remember that Biden deepfake robocall a few weeks ago? Yeah, the call attempted to dissuade registered Dems from voting in the New Hampshire primary election. The call has actually been traced to a Texas company and its owner.
Yeah, I remember that. We talked about it so much. Well, the people responsible for that fake audio call could face criminal and civil charges. New Hampshire Attorney General John Formella said, citing laws that prohibit voter suppression and displaying an accurate caller ID with the intent to cause harm. Great that these rules are in place, but it just reminds me that folks can get around them still.
Okay, so he described the episode as a real-life example of using AI in an attempt to interfere with an election. And I guess you could say the good news is that they were able to trace it and figure out where it came from. The not so good news is that this is just the beginning of deepfakes in politics, at least according to our next guest.
Get ready, everybody. Wendy Thomas back with us, President and Chief Executive Officer of the publicly held cybersecurity and risk management firm Secureworks. She joins us on Zoom from Atlanta. Hey, Wendy, so great to have you back with us. Yeah, walk us through kind of your expectations about deepfakes in politics, what you guys are seeing and anticipating.
Sure. Thanks for having me back. And, when we spoke in December, this was the use of deepfakes was definitely my top concern because, frankly, our lack of awareness, let alone preparedness. And so whether it's used in misinformation in election campaigns, clearly we've got not just the U.S. coming up with a presidential election in the fall, but nearly half the world's governments have elections this year. So the prevalence of the ability to use very low cost, low barrier to entry AI applications for nefarious purposes to misinform or to dissuade voters in some way is something that's top of mind for Secureworks.
What can Secureworks do to prevent this from actually happening? What can anyone do, Wendy, to prevent this from happening? It seems like there's nothing. Convince me that I'm wrong.
Well, I will convince you that you're wrong, and I will say, importantly, I think it's got to be understood that AI is still absolutely primarily used for the good, for defenders, for great business purposes, for scaling organizations. But as we talked about before, there's always a power and a peril. And so what we see that companies can do, what organizations can do, what we as individuals can do are a few things. I'm always going to say that awareness is the first line of defense. And so incorporating this awareness into training for folks, for individuals, for employees on your team is important. But there's also some simple tools to enable verification. And these have been true for some time. But what you're talking about now is social engineering that's been around for some time, whether it's emails or voice calls, just taken to the next level by compromising someone's identity. And so think about simple ways to ensure verification. Look, for a small organization or even a family, kind of a nonsensical passphrase that just a few of you know, the CEO, the CFO, you and your spouse, that it truly is you, is a great way to have a low-tech version right away.
I don't know, Carol. You're asking us to be the last lines of defense, okay? And I'm sorry.
Makes me nervous.
I'm just not optimistic. Anyway, Carol, I know you were going to ask something.
Well, you guys are publicly held. This is your business. So how much demand are you seeing? Talk to us a little bit about, the business side of the equation, how that translates. These concerns translate into more business for you. Talk to us about growth. Talk to us about demand.
Sure. So we just finished out our fiscal year end last Friday. So I'm going to be careful about our quiet period here. But we do see both from our existing insights into incident responses that we're pulled into, as well as conversations behind the scenes with law enforcement, that this type of next level, next generation of social engineering is real for companies, and they aren't ready. And so if you think about the business that we're in terms of the ability to detect anomalous activity that in this case is also malicious, and to respond quickly to both prevent this in the future, but to prevent any damage in the midst of a situation where maybe that first line of defense has failed, and you've got 2 and 3 behind it, right? That's what Secureworks does. Our ability to help customers both prevent this and not sustain damage from it is what Secureworks does.
Hey, Wendy, what I do wonder too, the bulk of your business, right? I think revenue is in the United States, largely, no doubt about it. But you also do a lot of business overseas. I am curious, where is the growth market for you? I'm just curious about, I feel like a lot of U.S. companies and folks have a lot of systems in place, and maybe that's not the case outside the U.S., but certainly if you're dealing with kind of the emerging areas. But make me smarter. Help me understand kind of where your demand is and who's really seeing an increase in problems.
Sure. We definitely still see demand in the U.S., particularly for more small and medium-sized organizations who haven't necessarily invested at the levels that large companies have, simply because those companies were the first areas that were attacked. And as we've talked about with the emergence of ransomware, really anyone is vulnerable, a municipality, a small business, even a school or a hospital. And so the need relative to the risk has definitely increased in those non-traditional organizations that are being attacked. We do see more growth outside of the U.S. simply because of the security maturity cycle in different regions, and frankly different regulatory regimes. But we see great growth in Europe and in Asia in particular, Middle East as well, where the pipeline manufacturing sectors and frankly global cyber warfare along with kinetic warfare is causing other countries to really take up their game in terms of security defenses.
I'm still stuck on this idea of this world that we're living in as being one where we're the kind of the last lines of defense. I mean, it makes sense when it comes to phishing and stuff like that. We know not to click links anymore, but it still happens, Wendy. What's a way that we can spot deep fakes as we enter election season? And we get robocalls. What should we be on the lookout for?
Well, you should always be on the lookout for things that you didn't go to the source. The call came to you versus you calling your bank or Amazon, what have you. So always be careful to never take an incoming call or email as who it is. Go to the source. And the big thing is, trust your gut, right? If something is off, what we see in these early deep fakes is that there is more pausing, like in an interactive video or voice call that's not pre-recorded. There's just a little bit of a hesitation before the machine responds, if you will, or the pace at which they're speaking is not the same. So it's just absolutely being thoughtful about pausing and being thoughtful about accepting something as real. And when you're talking about particularly where there's an inequality psychology, right? Someone is trying to rush you, to push you. It's a title difference inside of an organization. You absolutely can't fall into that psychology. And for leaders of organizations, you have to create a culture of challenge, right? This is no longer the trust but verify. It is the do not trust and verify in multiple ways.
Yeah, I feel like we have to be constantly on guard. Wendy, thank you so much. Good to check in with you again. Wendy Thomas, she's President and Chief Executive Officer of the publicly held cybersecurity and risk management firm Secureworks, joining us on Zoom from Atlanta. This is Bloomberg.
I'm driving in my car. I turn on the radio.
Yeah, how about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we've got just about 17 minutes left. Actually, 18. Let me do my math correctly. 18 minutes left.
That's right, Carol,
In the
18.
trading session. Whew. We got stocks pretty much near their highs. You heard Charlie breaking it down. It's kind of interesting. Some enthusiasm back, certainly on the equity side of things. Once again, it's those tech names. But the S&P 500 up 0.8%. NASDAQ up almost 1% here. And we're looking
Did we
at...
hit 5,000?
I got to bring
think
up my
we did.
numbers yet. I don't think we did either.
No.
Let me just pull it up on the Bloomberg. Nope.
Not quite.
49.99.89.
Oh, you
just
can't.
do
Can
it.
you round that
Push
up?
it over.
All right. It doesn't matter.
Come on, technicians.
Doesn't
Just do
matter?
your part. It's just a round number.
Okay. Well, let's see what Larry Pitkowsky has to say. He's managing partner and portfolio manager at Goodhaven Capital
Let's ask
Management.
him.
He joins us on Zoom from Millburn, New Jersey. Larry, does it matter? Does 5,000 matter to you?
Hi, everybody. Hi, Carol. Hi, Tim. That kind of thing does not matter to us here at Goodhaven. We do, of course, pay attention to the overall level of the market in relation to future earnings, just as a guidepost for how overvalued or undervalued things might be in a big picture sense. But then we just go back to looking for a handful of things that we think we can understand, try and dig really deep to try and understand them, worry all the time about what could go wrong, and be opportunistic when there is trouble out there in the world to try and take advantage of it for us and our fellow shareholders.
Well, so just going back to some numbers here on the market, you've got an S&P 500 that's up almost 5% here, a NASDAQ that's up 5.5%, and then you've got a 10-year that's going to pay you 4.1%. So I'm just trying to figure out, I know it's not all apples to apples, but I'm just curious, when you look at the markets overall, is it the equity side of the universe or investing universe that you still find interesting?
We are fortunate, Carol, that we've been able to construct a portfolio. With the Goodhaven Fund, we just published our annual report, and we threw in some statistics about the multiples and the growth rates for our portfolio, which to us look a whole lot better than the overall market. Cheaper valuations, better growth rates. So there are still things to look at and do, even in a market that might be, somewhere around fully valued. So we are fortunate to be able to have been able to do that so far. And I think if one is not moving around $100 billion, there should still be some occasional pockets of opportunity.
Hey, we should note that the 5-year performance of the Goodhaven Fund puts it in the 98th percentile versus peers. About $230 million in assets, average annual return of 14% over that period of time.
Congratulations.
Yeah, it's really.
Thank you.
It's been a crazy couple of 5 years.
We are working hard here at Goodhaven for all fellow shareholders, but thank you.
How do you get the AUM higher?
I don't know. We are making some efforts to raise awareness, but we figure if you build it, they will come to a great extent. We're less focused on that and more focused on just driving returns for us and our fellow shareholders. And we figure if we continue to do a good job and and Tim and Carol continue to mention it on their show.
Hey,
you're welcome. You're welcome.
Thank you. That more new and like-minded shareholders will gradually find us. But I'm getting younger, so I'm not really that worried about it.
All right. Well, you have the secret
Well,
then.
performance
You're getting
is
younger.
important, like as a metric. I feel like, right? If we're going to have somebody on, we do have a viewer listener writing in, and they say, what would you recommend to an investor considering investing a lump sum into a mutual fund at this time? Whether to break up the amount, do it over time, or do it all at once? The concern being whether valuations, as you address at this time, are high, and if a recession or other event comes, it will bring down all or most stock prices. It's a really smart question.
It is a smart question. I don't have a very smart answer. The ability to time, it'd be great to have the ability to time the market. I wouldn't have to work so hard, but I don't think I can do it. I'm suspect if, many people can do it. And so, we will just always, try and leave some room when we're buying things in case the securities we're buying go lower and the fundamentals remain intact. But we don't believe we have the ability to time the market, though I wish we would.
But what would you say to somebody who's looking to invest a lump sum right now? Should they dollar cost average? Should they do it all at once?
We're not in the financial planning business, but I would always say there's nothing wrong with, investing, gradually. But, you also, there's wonderful studies about, if you've missed certain big days in the market over, a year or two, you really miss a lot of the returns. So it's very hard to do. But
all right.
So I really don't have a great answer. But, try and be gradual, but just don't really try and time it. That's is as good of an answer as I've got.
Agreed.
Don't try and time the market.
All right. Having said
Did you hear that, Carol?
Yes, I did. Okay. I know. I feel like my whole business career, everybody's always been like, don't time the market. Although I do think you can be smart.
It's easy to do it when you look back.
But I also think
October 2022 would have been a great time to throw some money.
Well, one thing, Carol and Tim, is when there is, we try and potentially, when we see smoke, we try and run towards it and see maybe there's really not a fire. So when there is more pain and suffering in a sector or in the market overall, and if you have some reserves, it is the potential time to get more aggressive, not less aggressive. Well, and if there's complete and utter, crazy euphoria, you may want to consider becoming a bit less aggressive. So I think that's a useful thing for people to think through as a mindset.
Well, having said that, then something like regional banks, would you run towards regional banks right now? Some of the names that are getting beat up or just the sector brought down because of concerns about New York community?
Well, it's a very good question. In the fund shareholder letter, which we just released, we said that the biggest addition to capital in 2023, which was mostly in the second half of 2023, was Bank of America, which was done on the back of the crisis that happened last spring with Silicon Valley Bank and Signature Bank and then later First Republic. So we looked around during that period, and in the aftermath of it, we decided to dramatically increase our exposure to Bank of America. And Bank of America is not a regional bank.
No.
But, sometimes there are sectors where, the baby gets thrown out with the bathwater, so to speak. And we found what we think is a good opportunity, and still looks, Bank of America to us, to be a good opportunity on the aftermath of what was the spring of 2023 crisis. So, it's a good place always to be looking, where there are headlines, negativity, and, some dramatic potential declines.
Hey, just 30 seconds on Berkshire Hathaway. It's the biggest holding in the Goodhaven fund, up 11% year to date, 52-week high today. What do you love about Berkshire?
We made Berkshire our biggest holding during the COVID, the middle of 2020. What's not to like about Berkshire, except, of course, it's very big. We still think it's undervalued. We followed and owned the company for many decades. And in that period, middle of 2020, we thought the price was very attractive. Right. And we still think the price is undervalued. And we think they have laid out a forward-thinking succession plan, which makes sense to us.
Larry Pitkowsky, thank you so much. Really appreciate it. This is Bloomberg.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.